American economy lost jobs last month, and the 10-year Treasury yield went up. If you have been investing at any point in the last 6 years, that sentence should stop you cold because it is not supposed to happen. Weak jobs are supposed to mean lower yields. That is the reflex. Today the reflex fired, and the bond market refused to play along. I want to show you exactly why that happened, because it changes what a lot of people think they own. Let me set the scene because the backdrop is the whole story. Since 2019 and really since 2020, markets have been trained on one simple loop. Bad economic news arrives. The Federal Reserve is expected to cut interest rates. Lower rates make future profits worth more today. So anything with a long duration, technology, growth stocks, long-dated bonds, crypto goes up. Bad news becomes good news. That loop has been so reliable for so long that most portfolios now have it baked in, not as a position anyone chose, but as an assumption nobody re-examines. People call it the Fed put. The belief that if things get bad enough, somebody steps in. And today we got the cleanest test of that belief in years. Here is what actually printed. Nonfarm payrolls for July came in at negative 23,000. The economy did not slow down. It shed jobs. Wall Street was looking for a gain of about 83,000, so the miss was not a small one. It was more than 100,000 jobs wide, and it broke in the direction nobody was positioned for. And it gets heavier underneath. The government lost 53,000 jobs. The 2 previous months were revised down by a combined 103,000. May was cut to 63,000. June was cut all the way down to 20,000. So the trend everyone thought they were looking at last month was quietly a different trend the whole time. And then the twist, unemployment did not go up. It went down because the labor force shrank. So here are the 2 numbers that frame the day. Wall Street expected a gain of 83,000 jobs. The economy delivered a loss of 23,000. But now look at what happened to the unemployment rate, because this is where almost everyone reads it wrong. The unemployment rate did not rise. It fell to 4.1%. Consensus had it holding at 4.2. Think about how strange that is for a second. The economy lost jobs, and the unemployment rate improved. That combination is only possible one way. People left the labor force entirely. They stopped being counted. Labor force participation rate fell to 61.4%. That is the lowest it has been in more than 5 years. And average hourly earnings cooled to 3.2% year over year, the softest wage growth since May of 2021. Now put those pieces together, because this is the mechanism that matters. There are 2 completely different ways an economy loses jobs. In the first one, demand collapses. Companies stop selling things. They lay people off, those people look for work and cannot find it, and the unemployment rate climbs. That is a recession signature, and a central bank cuts interest rates into it because the problem is not enough demand. But that is not what happened here. In the second version, the supply of workers shrinks. People retire or stop looking or leave for reasons that have nothing to do with a business cycle. Payrolls fall, but unemployment falls too, because the people who left are no longer counted as unemployed. And here is the part that really matters. When the workforce gets smaller, the economy's non-inflationary speed limit gets smaller with it. The same amount of spending is now chasing the output of fewer workers. A shrinking labor force is not a disinflationary event. It can be the opposite. So watch what the bond market did with all of that. The 10-year Treasury yield rose to roughly 4.68% on the day the economy printed job losses. In a genuine growth scare, yields fall hard and fast. Rising yields on weak data means the marginal buyer of government debt is pricing something other than a rescue. It is pricing government borrowing needs, and it is pricing inflation. And the inflation part is not hypothetical. Consumer Price Index ran at 3.5% year over year in June. That is above the Federal Reserve's 2% target, and it has been above that target since 2021. Now here is the context almost nobody outside of rates desks is carrying. At the July meeting, the Federal Reserve held rates at 3.5 to 3.75%, but 3 officials dissented. And they did not dissent in favor of a cut, dissented in favor of a hike. The internal argument at the last meeting was about tightening into all of this. The chair, Kevin Warsh, has been in the job since May, and he has deliberately stopped giving forward guidance. He has said his mandate is to deliver price stability. So you cannot read the path off a speech anymore. You have to read it off the inflation data. And the futures market has drawn its own conclusion. The exchange's own tracking tool puts a greater than 90% probability that the federal funds rate is higher at the end of this year than it is right now. Higher, not lower. Now let me be honest about 3 things that cut against me here, because a read you cannot argue with is a read you should not trust. 1, this is a single month, and payroll data is noisy and heavily revised. We literally just watched 2 prior months get revised down by 100,000 jobs, which means this print will be revised too, possibly in the direction that makes me wrong. 1 month is never a regime. 2, falling participation can absolutely be an early recession symptom rather than a supply story. Discouraged workers stop looking precisely because the jobs are not there. If that is what is happening, then this is a demand collapse wearing a supply costume, and the Federal Reserve will eventually cut, and cut hard. I cannot fully separate those two explanations from 1 month of data, and anyone who tells you they can is selling something. 3. Wage growth genuinely cooled to the softest since 2021. That is real disinflationary evidence, and it argues directly against the hawkish case I have just walked you through, so I am not going to overclaim. I am going to state this narrowly and precisely. Here is the precise claim. I am not saying the Federal Reserve will hike in September. I am saying something narrower and I think more useful. The probability that nobody rescues this is materially higher than the way most portfolios are positioned implies, and the evidence for that is not my opinion. It is the 10-year yield going up on a negative jobs print, 3 dissents in favor of a hike on the record, inflation above target for 5 straight years, the futures market putting better than 90% odds on rates ending this year higher. That is 4 independent pieces of evidence pointing the same way. And the setup around it makes it matter more, not less. The S&P 500 closed above 7,700 for the first time in its history on August 3rd and printed a record with the Dow at 54,000 on August 4th. We are 2 sessions off an all-time high. The negative payrolls print and a rising long bond. Most portfolios built over the last 6 years have a Fed put embedded in them as an assumption rather than a position. Today, the bond market quoted that assumption out loud, and the price was higher than people think. Here's my call, stated so it can be proven wrong. By the September decision, I expect the federal funds target will not be lower than 3.5 to 3.75%. If the Federal Reserve cuts in September, I am wrong, and the reflex everyone is trading was right all along. And here's the single test you can run yourself, without any of my analysis. Watch the 10-year yield on the next soft economic print. If yields fall, the old loop is intact and a rescue is being priced. If yields rise again on bad news, then today was not a fluke, it was a regime, and the thing to re-examine is not your view. It is your duration. What do you think, is the Fed put dead or just late? Tell me below. I'm Frankie. Research and education only, not financial advice. The full market picture today, including gold, oil, the crypto bill, and the board, is in Earl's Daily Brief. Link in the description. Subscribe.